Hi everyone, welcome back. As usual, I'm here weekly basis to share with you my views of market, both what we can expect from the fundamental and from the technical point of view, right? Anyway, despite we are of course going to comment the most relevant macroeconomic figures to be released this week, the fact is that the market is all about dollar weakness these days. Uh, there are multiple reasons why the dollar is easing. The first one is probably that the market has priced in three rate hikes too early, too fast at the beginning of the year. The other one is the new US administration, Donald Trump, leading the world's largest economy with a lot of promises of little action. And now, with all this scandal with Russia and the FBI, generating uncertainty among investors. The final and not because not the less relevant factor is that US data has been softening, right? Despite the readings are uh, in line with a rate hike, in line with growth in the country, the numbers have been disappointing and falling, right? Slowly retreating, somehow suggesting the growth in the country has decelerated over the first quarter of this year, also soft into the second quarter, right? So overall, despite whatever data has to offer this week, the dollar is soft, the dollar is weak, the dollar is bearish. Therefore, any kind of macroeconomic release that supports uh, a bearish movement in the dollar will be more relevant than those that support a bullish move in the American currency. You know, when macroeconomics go with technicals, the movements get exacerbated. So, uh, and when they are opposite to them, the most likely scenarios that currency, right, being benefit, we are talking about the greenback in this case, but this applies to every currency. The dollar may get a spike, get a correction in this case to the upside, but the movements tend to be short-lived, right? Anyway, so far so good. Earlier today, Europe released its first quarter preliminary GDP, which came in line with expectations, no big surprises, showing growth in the area, something the PMI reports have already anticipated somehow. But this zero point 0.5 is telling us that the risk of remains towards downside toward in the European economy. You know, it's not really solid growth, and what we are seeing in the rest of the economies, dismissing Germany, of course, suggests that the risk is not over in the region and that growth may slow in the upcoming quarters. Okay, beware of that in the long term. Also, I was watching the outcome of the sales survey. Economic sentiment kept growing in the euro area, although at a slower pace than the market was expecting, particularly in Germany. Anyway, confidence is strong, and I guess this strong sentiment surrounding Germany and the strong macroeconomic readings we have been getting from the country lately are another factor supporting the euro dollar ongoing rally. Okay. Next are some housing readings in the US. They are usually relevant, but they are not relevant enough to change the ongoing trend, right? So this is one of those cases when it said the building housing numbers, even industrial production a little later could trigger a dollar recovery, but it probably will be short-lived, right? The week is fulfilled with data, but I'm not sure how relevant it is. I do believe that the most relevant readings we are getting this week are employment figures in the UK and inflation in the euro area. Today we had inflation in the United Kingdom, something I forgot to comment. And despite the pound's spike up to 29.60, it was unable to sustain its gains and quickly pulled back below the 29 level. Uh, Increasing inflationary pressure should mean that the Bank of England is getting closer to hike rates, right? But even Bank of England stance from the previous week, that seems a bit less probable at this time. And it's also waiting on the pair and on the pound particularly is the fact that we have elections in the United Kingdom in a couple of weeks, and the market is expecting that outcome before taking the big decision of breaking through 130. Anyway, Employment data to be released on Wednesday is quite relevant and could back a rally. I would be focusing particularly in wage because we have a rising inflation, but wage are doing not that good. We're expecting a thick in there, maybe that alongside with a strong headline, right? Will back at the pound a bit longer, but still not seeing the pair breaking clearly beyond 130 ahead of the event. And when it comes to European inflation, ECB's Draghi has been repeating to exhaustion that tapering is not on the table these days, that it's no time for tapering, that it's no time to consider reducing stimulus, that the risk remains towards the downside, etc., etc., etc. Nevertheless, inflation is near, right? The ECB's target, right? It has been for a couple of months, it keeps rising. So somehow these stronger inflation figures are pushing Draghi's hand towards a rate hike. Okay, at least the beginning of tapering easing facilities. It's an unlikely scenario given Draghi's stance, but nevertheless, the market will bet on that upcoming future in the euro. The market is moving way ahead of the events lately. We have already talked about this in previous shows. And therefore, beware of further euro gains and a bullish breakout, strong one in the pair, beyond the one we already got today, in the case of rising inflation. Okay. In Australia, the only relevant figure to be released this week will be the employment data on Thursday. As I always said, this is something quite particularly because it just affects the Aussie, right? It hardly affects the rest of the mayors. Of course, it has some effects on the New Zealand dollar, but that's it. Anyway, we will talk about the Aussie later, but employment has been a tough sector, a problem for the Reserve Bank of Australia lately. So beware of these readings because soft number could see the pair plunging even further despite the bounce we have these days. The bearish trend in the Aussie remains quite alive. Okay. Beyond that, there's not much more in the calendar until Friday when we have some data coming in Canada. Also, as I said, particularly affecting this currency, the Canadian dollar. Uh, Not seeing much of it being able to move the pair, the cat dollar pair, beyond its correlation with oil prices, right? Oil prices and treasury yields have been leading the way in the market for most of the past 2 months, and that scenario will likely persist, right? Particularly when it comes to currencies beyond the European ones. Anyway, let me change the charts, which, as usual for me, are far more interesting than the macroeconomic calendar. Here we are with the euro dollar trading around 110.60. Okay, its highest for this year. The upward momentum we are seeing lately, I have already explained a lot of uncertainties surrounding the US and a bit more of confidence in the euro area, moreover, after Macron's victory in France, and with inflationary pressures rising and forcing Draghi's head. Okay, technically, ever since the pair broke above the 61.8% retracement, the outlook is bullish, and despite the pullback we saw last week, that was quickly reverted. I'm still seeing the pair advancing further. I was looking at intraday charts with technical indicators in extreme over both territory, but in the daily and in the weekly, there's plenty of room to go, as you have seen. So I would expect some consolidation to let indicators settle, some I don't know, a small downward corrective movement that anyway, if it holds above 110, will keep the bullish trend alive short term and long term, right? In the wider view, I do believe that now 930 has become a major support, and corrective movements down towards that level will hardly harm the trend. But anyway, as I said, very, very bullish. 110.60 has been tested above this 111 1110, sorry, is the next bullish target, and with scope to advance up to 1216 over the upcoming weeks, particularly if the current scenario remains unchanged, right? Short term 110 is the immediate support. 109.50, 60 area has provided some support resistance, right? It's an intermediate, not relevant one, followed by the 930 area. And below that, 890 is for me next, really not seeing the pair easing down to that level this week unless we have some big news able to take either the euro down rather than the dollar up. Okay, it's about euro strength or weakness these days, the possibility of a pullback rather than the fact that we can get some dollar strength news. When it comes to the dollar pound, the fact is that the pair has been consolidating well in the range. 128.30 seems to be the base. 130 is where selling interest awaits. But the fading upward momentum, it's getting clearer daily basis. Despite the neutral scenes from technical indicators, the risk is for me towards downside because if the pair was unable to hold above 29 today, with inflation, it will hardly find a reason to rally beyond 130 over the next few days. The risk for me, therefore, is towards downside. That mentioned 28.30 is for me the immediate support low for the previous week and where the pair stalled multiple times in the past also, followed by this 27.60, 70 region, which are the lows, right, where the pair bottom after Theresa May announced the early elections for June, right? So that 2760 region is sort of a key. As if the pair breaks below it, it has room to extend its decline and correct all of its gains and move back towards 126. Not something that will happen in one day, but there's scope for that. Anyway, as I said, selling interest is strong around 130. So somehow the pair needs to break above it. Not sure what can trigger such move, but in the case it happens, I do suspect large stops above the 130 area, and therefore a breakthrough those stops will probably lead to an advance up to 130, 60, 70, right, as an immediate move, and beyond the level 130, 120, 130, 140 comes as the next probable bullish target for this week, okay? The other one trading pretty much uneventfully is the Japanese yen. Let me move to my daily. This is the November-December rally, and we have a huge resistance around 1450, which is the 23.6% retracement of such rally. If you take a look, the pair has been able to clearly break through that level ever since the year started. We have a couple of spikes past it and being quickly reverted, right? This past week, we had the pair testing and pressuring the level, and anyway, unable to break through. Most of what's going on in here, it's depending on the American Treasury yields. You know, the yen has been moving with yields, right, and unable to find another reason to move, right? The pair is a bit out of tone, ignoring pretty much U.S. fundamental releases, macroeconomic releases, something that usually moves the pairs one way or the other. Now it's being completely ignored by the market, and yields are taking center stage with rising treasury yields pushing the price higher and falling yields pushing lower. Anyway, as I was saying, mid-range consolidation, not much to say it in here. That 1450 high, Fibonacci resistance is key. There's little room for an upward move as long as below it. I was taking a look at the daily and today, and still there's no technical reading favoring a downward move, right? So far, the pair has bottom around 1310, 1320 after being rejected from that low, from that high. So therefore, 1450 is the range to play, and a clear break of any of such strength is required before the pair is able to gain some directional strength, right? Still, I won't risk towards the upside for too long. If we break above 14.15, right? The high around 100 pips higher set early March is tops for the pair. I'm not seeing much of a reason why the dollar should gather such momentum to break across 1550. Okay. And okay, let's go for the LC. I was saying today about the LC, it has been clearly bearish ever since topping in March around 77.50, right? And latest recovery, right, seems just corrective for me. We are well below that trend line. In fact, we failed to surpass it there early May. We have a couple of attempts, but I leave it there because the moves above the trend line were unsustainable and being quickly reverted. But anyway, despite there are no bearish signals coming in intraday charts, I do believe that the risk remains towards downside long term, right? Particularly after the failure to regaining the 74 level. And as long as the trend line holds today in the 74.70 region, okay? Take a look at that trend line and follow it. The immediate support right now is the 33.90.80 region. And below that, the pair can retest the lows around 73.30, right? While below this one, I do expect a super bearish move towards 72.15, which is a major long-term support, and where I do expect the pair to hold this line. Particularly because there's not enough dollar demand in the market to push it lower. Okay, it's mostly weakness, but with the dollar also weak, maybe it's not the best pair to trade these days. Anyway, to the upside, 74.40, 74.60 area, right? It's the immediate resistance. I mean, 40 because of yesterday highs and previous lows in the region. And the trend line, and only a break above the trend line could revert the negative sentiment towards the OC, right? But the pair needs to advance beyond 75.10, right? Settle above that region to be able to be turned up bullish, right? The bearish pressure easing is not the same as being bullish. 75.10 is for me the line in the sun. Oh, oil prices, right? We have sort of a dead cat bouncing here. That's what I'm thinking of the latest oil recovery. Indeed, the commodity has been advancing ever since bottoming around 43.70 a couple of weeks ago. But honestly, I do believe that the market is not really ready to push oil beyond 50, right? The latest recovery, this week recovery, has been based on comments from Saudi Arabia and Russia oil ministers who anticipate that they will uh, extend their oil output cut towards March 2018, right? Over 9 months. The market was thinking of an extension towards the end of 2017. And all of a sudden, we have an extra quarter of cuts, right? But whatever effort OPEC does, right, it's being offset by increasing US production. Last week, the recovery was backed by a surprise drawdown in US stockpiles, but we are waiting for fresh numbers, right? We have the AP report today and the AEI tomorrow. So if those numbers show that US stockpiles keep rising, the most likely scenario is that the oil will pull back and it's most of its latest gains, right? The worldwide glut is far from over. OPEC efforts are being offset by by American production. Therefore, there are not much reasons for a sharper rally beyond the 50 level. Anyway, if somehow the commodity advances beyond 50, 20, 15, 30, which is the immediate resistance, the The recovery can extend up to 52, which for me should be tops. Okay, towards the downside, I'm watching this area 28, 20, 48, 20, and 47, right? The previous yearly lows as the main supports. If we take this back, then there's a good chance that the commodity will retest 45 and even move lower beyond that 43.70 towards this low set last November around 43, right? And when it comes to gold prices, we have seen a tepid recovery lately because, particularly because of dollar weakness, right? But to be honest, the recovery seems quite shallow and not enough to think about interim bottom having been set in gold prices. And the fact is that the Fed's still in the tightening pattern, therefore, there's little the commodity can do to recover the bullish momentum seen earlier this year. Okay, I'm taking a serious look in the daily chart to the 100 and 200 simple moving average. The 200 is the brown one. It has been tapping the upside for over a week. Today we are have open above it, but still below the 100. The 21 is heading lower above it. Indicators remain directionless below their midlines overall. I do believe there's little room towards the upside unless it recovers above 1243, 1245 would be a better indication that the commodity has shrugged off the negative tone. Okay, only a daily close above this level. Not seeing it at the time being, even despite the ongoing dollar weakness. Okay, anyway, not much of a trend being developing here. The upward momentum, short-term upward momentum seen lately is fading. Beware, as I said, about 1245 as the main resistance. And as support, I'm considering this area, sorry, around 25, 26, which is for me immediate support. If we take it down 1240, the May low, it comes next. 1208 has been a major support earlier this year. So I would like to see the price below that level to think about a bearish extension. Okay, from there on, that could go down to 1150. As we said multiple times, remember the cost of that producing, a ton of gold, it's around 1100, 1150. So once 1200 gives up, there's little scope towards downside, but there's room, of course, for a downward move. Anyway, rather than consider selling, it's a time for not considering buying gold at this level, so probably waiting for a deeper retracement before moving or betting on a recovery from near production cost. Okay. Anyway, that's it for today. I hope you enjoyed it. See you soon. Not sure when. There's not much big events coming on, but hey, I will be here next week. Thank you and see you soon. Goodbye.